Okay, so well, let's start with I think it's the most important uh, thing going on today, and not only today, but really across the last few days this week, and it's we've been um, it's a strange world to think that we've been having to convince people about the thesis to invest in gold and silver and so forth and hard assets. But if there was ever an environment, in my opinion, that those types of investments would work, this to me is a very seems like a very opportunistic time to be invested in hard assets. And what's happening today that is so important is the quarterly close. This today is the last day of the quarter, and gold is actually about to close at all-time highs. Not only all-time highs, but breaking out. And if you look at this chart and you compare the moment today with the early 2000s, which I think is, I can argue that is very comparable from a tech bubble perspective. You have the early stages of a commodity markets. You have this revamp of manufacturing and infrastructure developments happening with China. And today we have the G7 economies. I would even go deeper and say, well, we didn't have inflation back in the early 2000s. Today we do have inflation. We have a much more indebted economy relative to the early 2000s. Anyways, but just look at the length of the cycle that we saw back in the early 2000s for gold market, but also the number of candles on the quarterly basis that we had of green candles, and you can count on your own. In my opinion, we're entering a bull cycle for precious metals overall. And if this is indeed the case that we're now confirming this or validating this thesis as we speak, then there are a few things in the markets today that I think are offering incredible opportunities. Let's go to the next chart because we often talk about the two waves or three waves of inflation, but how about the second wave? Well, we're of second wave of free cash flow that the miners are seeing in the last, call it 2 quarters or so. This is very recent. The data came in, and I like to look at the data when the miners report their numbers, and I have different models that I like to look at. I look at the top 10 companies, the top 20, the top 30, the top 50, and I try to see if there are different types of trends happening across those companies. If it's just the major companies, and you can see in different ways, but basically prices are really cheap. Essentially, prices have come down substantially in most of the miners. The fundamentals are improving. The whole story that the cost structure of the miners is very challenging and so forth. It is, and it will always be the case. But the fact that gold prices and other metal prices have been rising, it's making it more and more economical. And so the fundamentals have been improving drastically. And so we're seeing underlying metal prices actually breaking out. And gold is the chart that I had in the prior slide. And you can see the same happening with copper and silver and zinc and so forth. And the market sentiment remains, excuse my language, but in the toilet. And so it is perplexing to see that because in my view, as I said before, when you have gold breaking out and the GLD, Kevin had a funds or AUM or assets under management actually increasing in GLD, but not to the same degree that we've seen the price run up in gold, which proves, and logically speaking, that potentially who's buying gold is central banks, and central banks don't buy the miners, and therefore the miners have not received the inflows yet. But I do think that that's going to change because as market participants start seeing the potential for asymmetry as gold prices continue to run up and potentially even enter a bull market, a long-term bull market, which is usually a secular move, then the miners are completely uncrowded and then can actually see very significant re-ratings. And that window of opportunity, I used to say 6 months or so, it's closing up very quickly. Let's go to the next chart. Here's another one about valuations that are interesting because prices came down so much and the fundamentals are improving. You're starting to see some really interesting fundamental multiples showing or proving that the miners are really cheap. And this is not no, you don't need to have a view on gold. You don't need to have a view on commodities, or it's just a view of value investing and just calculating how historically these companies are really cheap. And the median price to book in this case, it resembles the period of the 2015 period when the miners are really cheap as well. And we saw a run up. It was sort of a short run up in prices of the miners. If you ask me, I think what we're going to see here is a much more long-standing trend towards precious metals. I can't think of I was in this conference in Switzerland. I've we went to PDAC in Toronto. We talk to investors all the time. I cannot, and please correct me if I'm wrong, anybody here, but I cannot recall any other industry that is more hated than the gold miners. And maybe not uranium, maybe not silver miners, but gold miners is specifically as hated as they could be. And so, in this industry of money management, usually skepticism tends to morph into opportunity. Not only that, but when you have this level of neglection towards a certain industry, or level of people just ignoring a segment of the market for so long, it creates very large inefficiencies. And those inefficiencies in the mining space are across many different ways. I mean, it's not just a lack of capital issue. I mean, Quentin can talk extensively about the fact that we have shortage of geologists. And so the more you go to the left side of this industry, where exploration requires more knowledge about geology, it would probably be the most inefficient part of the industry, because there's just a lack of people looking at those assets. And so, so we see companies putting out incredible results, in our opinion. And so intrinsically, we see companies actually improving the probability of their or the potential of finding reserves. And at the same time, the price of those securities is not aligned with those probabilities increasing. And so that's what we call inefficiency. But inefficiency is also another word for opportunity. And I view this as a major opportunity for positioning in the portfolio. Let's go to the next chart. Not just me, but everyone here. Quentin asked me the other day, hey, Tavi, I know you look at all these ratios. Have you looked at the Newman to gold ratio? And I said, well, I can do that in a minute. And so I did it. And then I was shocked. I was like, man, how is Newman trading at the same levels it was trading at 2015? And that's actually the lowest level in history, or one of the lowest levels in history, if you want to be more specific. But really forming potentially a double bottom in this chart. I'm not very technical, but I think the much more compelling thesis here is the valuation, is the potential for gold turning. It's hard to believe that gold would enter a secular bull market and Newmont wouldn't participate in it, but that's just my 2 cents. But and by the way, this is not to pick on one specific company. I think there are many other examples of companies that are trading at very, very low multiples today in the gold space, and this is just one ratio, given the fact that Newmont is a leading company in this industry. Let's go to the next chart. And so recently we've seen this trend happening, by the way, and I think Kevin had a chart from Roni, and they actually had a really good report on In Gold We Trust, which they do every year. But I think was the last one, was specifically about how the accumulation of gold has been happening in Eastern societies. And if you haven't had the chance, you should read it, because it's really interesting. They got many charts kind of proving that thesis. Nonetheless, this chart is kind of doing exactly the same, and it's basically looking at the Chinese gold imports or basically Swiss gold exports to mainland China and Hong Kong. So you're seeing the surge of gold imports in China and Hong Kong. It's really interesting. It certainly is kind of a sort of validating that idea that what's driving gold prices is central banks purchases. I know this is not central bank specifically, although it wouldn't surprise me if the PBOC is not the one behind this buying gold. But let's go to the next chart. And so, interestingly, when I look at that chart, it comes to my mind this chart that we had it in the letter. It's the main chart in the letter, which shows foreign central banks transitioning towards gold. The idea of this chart is just to show you how in the blue bars is the percentage of gold allocation relative to international reserves has been increasing. and how the government in the US specifically, but you can extrapolate this to other economies too, Germany and France and Italy and Australia and so forth. And what you're seeing is this massive issuances, a flood of issuances of government securities. In other words, those countries are essentially broken financially, so they're issuing a bunch of debt. But the problem is that there are no major buyers, and so that's the white line you're seeing. So essentially, central banks are participating less and less of the treasury market, in this case, in the U.S. treasury market, and so foreign central banks are transitioning away from owning a large percentage of treasuries into gold slowly but surely, and that's just what the idea of the chart really is. Let's go to the next chart. And so here is one thing that comes to my mind when I think about gold breaking out and making this quarterly breakout that I was showing in the very first chart. And it comes to my mind is silver, right? And then, thinking about other roadmaps that we've had in the past, this chart is just such a critical chart because silver today in the yen is actually retesting the highs of 2011. Think about that for a second. I mean, 2011 was a period when silver had a big explosive move to the upside, and today we're retesting those levels now, and not many people are talking about this. And what is likely to happen is that the white line, which is silver in US dollar terms, is probably going to follow the same line. I remember looking at a very similar chart of gold in yen terms not too long ago when people were saying that triple tops work. Remember that? Well, triple tops, I guess, did not work, and gold actually followed the pattern of the Japanese yen. And so I think this is a roadmap. And so I'm paying very close attention to this chart because I think we're very close to a explosive move in silver to follow or catch up with the blue line in this chart. Let's go to the next chart. And so here is one reason why I think a lot of commodities are going to enter a bull market. I can come up with many other, but here's a very important one. When you have this deglobalization trends globally, I guess, so deglobalization globally is a little bit too much of the word global, but deglobalization is a real factor in terms of the inflationary trends that we're seeing. And what creates is a need for economies to really reshore and really refocus towards their domestic operations and change the logistics and reliance that they have in other economies and so forth. And so what you tend to see during those periods, it's not only conflict between economies, number one, but also you tend to see economies actually building up or revamping their manufacturing plans. So, that brought to my attention when I was writing the letter. I was really thinking about when was the last time we've seen an infrastructure development in the U.S. and what are we seeing today relative to history? Is that really big compared to other periods? And I was shocked to see the numbers. Number one, if you look at the Marshall Plan after the World War II for the rebuild of the European countries and the global economy overall, and also the rest of the world actually overall spending in construction that we saw coming out of the World War II. The amount of infrastructure development we're seeing today in terms of the bill that was passed that will still be spent on construction completely dwarfs the amount that we saw back in those days. I mean, as you can see in this chart, I can see very well, but it's about 550 billion, call it. It's about 3 times. And Kevin actually made the point. It's like, Tavi, why don't you add the Inflation Act to this, the Inflation Reduction Act to this calculation? And after doing further research, indeed, I mean, the majority of the Inflation Act, believe it or not, is actually going to the Green Revolution idea. What is the Green Revolution? Well, we're going to have to rebuild a lot of things, one of them being the electrical grids and all sorts of electrification policies that we're going to need in order to accommodate those changes. And therefore, that is another form of construction. That is another form of demand for copper and other base metals that Quinton will talk about in a minute here. And so it is important if we consider that as a portion of the overall infrastructure spending that we're seeing today in terms of the acts that have been passed by the government. It is again, it completely dwarfs other periods. What is another period that we saw that was a very large, was actually kind of in line with the Marshall Plan, was in 1956, which was Eisenhower actually passed an act for infrastructure act that was called the Highway Act. I should be specific. it was about $25 billion authorized by the government to spend on infrastructure developments. And if you look at, by the way, all these numbers, before people try to correct me, all these numbers are looked into inflation adjusted. So I adjusted for US dollars today because that's the right thing to do. And by the way, the second bar that you're seeing that I showed three times, that is global spending. That's not US spending, that's global spending. So the yellow line is just the US. I'm not considering, any European country or any or Canadian the Canadian economy or Japan or Australia. I think all of them are going to follow suit personally, and I think this yellow bar, if you aggregate all the countries, is going to look really interesting in a few years. Let's go to the next chart, because I had another important chart in the prior letter, which was related to the infrastructure development, and the construction spending is actually surging. That's the red line. You're looking specifically at manufacturing. It's about $200 billion. It's really not that much. If you think about it, we're going to see probably a lot more. And if you calculate how much, the act has been already passed, and this is just public spending. What about private spending? Private spending is also going to play a role here. And so, you can extrapolate in different ways. What about another thing that we talked about in the letter that also Kevin actually brought it up, that point regarding data centers? We're going to have a rebuild of AI, and I actually think AI is very deflationary. I wouldn't disagree with that. I think it's highly deflationary. But let me put it this way: in order to become deflationary, I think we need to first build up the infrastructure that is necessary to allow that to manifest itself in the economy. And as we see that, it requires a lot of data centers, it requires a lot of chips, it requires a lot of things. And so the infrastructure development that will be needed to get AI to that magnitude of a trend on the deflationary aspect or disinflationary aspect is what's likely to actually drive inflation, believe it or not. And that's the irony of this whole situation, is that it's highly inflationary, the process to get there. And so that's the red line you're looking at. And the white line, you're just looking at how much producers, the companies we invest in, are spending on new investments or new projects or new forms of production of hard assets to allow the red line to be built. In other words, construction to be built. And so, there's a gap. We're probably going to see shortages of materials. And that's why you see every now and then a commodity surging in prices because of a lack of supply. And then people say, well, that's a unique factor with this, whatever. I tweeted the other day a chart of agricultural commodities. Somebody came up to me and said, well, that's just specific to cocoa. No, it's not. Have you noticed how it switches over time? It's always one new commodity, but overall the trend is higher. That's what's been happening. And so that hasn't changed at all. So pay attention to those things. It's the same thing happening with, the labor strikes. Labor strikes, people like to say that those are specific to situations with certain either countries or companies, but no, they are interconnected in a very large way, and probably the beginning of more of those trends continue to escalate globally. Let's go to the next chart. So copper to S&P 500 ratio, that's just an interesting chart, because if we're going to see that infrastructure development, that demand coming in, Kevin had a chart of discoveries of copper. Quentin is going to touch on this as well. Well, how interesting is the fact that back in the early 2000s, I was mentioning there the link between today's market in gold versus early 2000s. Look at the relationship there as well with the copper to S&P 500 ratio, in which was rising during that period drastically. And it was just one economy, China, was going through their own manufacturing revamp. What if we see this more globally this time? What does that do to copper? What does that do to hard assets relative to financial assets? Those are very important questions on that rotation thesis that Kevin was mentioning. Let's go to the next chart. Here it is. I happen to know one company that produces a lot of zinc. I happen to be not only Crescent's investors, but also we're also investors of this operation. And so it is interesting to see how zinc exploration budget, if you adjust for GDP, is actually down 70%. 70%. from its peak levels. It's mind-boggling. What do you think that causes? That usually, well, we're probably going to have that impact has a lagging effect on the supply of commodities, and Quentin will touch on that soon. But this is another way to kind of show how we're seeing a highly constrained supply environment for commodities overall. Let's go to the next chart. Here it is, inflation versus agricultural commodities. I find this chart interesting because I really believe in the thesis that we're about to see a second wave of inflation. I think 3 months ago it was very hard to make that call, and now it's becoming more evident. And one of the things that is actually pushing this potential for a reacceleration of inflation is actually agricultural commodities. They are actually up about 20% or 21% to be specific on an annual basis. And guess what? They have a 3-month lead on CPI. So, in our opinion, this is actually going to lead to higher inflation because it has an impact on food prices and all sorts of things. And so it's not just cocoa. It's probably going to be a lot of other things, including cattle prices and move, on and on from different types of commodities that could be linked to food prices and other things that are inflationary as well. Let's go to the next chart. And so if there's a second wave of inflation, I've never seen one that, or maybe there are a few in the past in history, but certainly energy is very likely to participate on that. And energy, I know when I showed this chart, actually Kevin correct me and said, look, you can look at this in a much longer period of time, and you can see that the relationship is a little bit different. I think my main point about this chart is that the energy equities have been very resilient. And energy equities are actually retesting the highs of the Russian invasion period when commodities really had a peak. And if you look at the blue line, which is specifically oil is basically has a 50% implied move if we're going to go back to those levels. And I do think that's likely to happen. And when I look at the cost of betting on that, meaning the call options on $100 strike on oil, and it's at one of the lowest levels in history. Well, okay, well that's that means nobody believes that we're going to see anything like that. And I'm contrarian at heart, and if I have a view that we're going to see inflation reaccelerating, well, I'd like that. I think that a call option on oil or energy companies are actually going to be the benefiters of this environment. Let's go to the next chart. And so the next chart now is showing something that concerns me. And I think some people have been calling the Fed political. And I'm not going to get into that because that's not the point of Kreskin. That's not the point of what we do. We're not political. We're just macro data driven. But it is weird to see this shift in focus from inflation to labor markets from the Fed. And they have all their reasons to go there because there is this acceleration on the labor markets. Now, on the inflation front, there's nothing to be celebrating. The white line here is showing the inflation expectation chart, and it's clearly on an upward trajectory. I mean, I don't think you need to be a PhD to see this. And on the other side, you have the financial conditions chart in red has been declining. So one is actually, adding fuel to the fire of the white line, and I'm concerned. I do think that this adds to that reacceleration of inflation thesis. I didn't think the Fed was going to, pivot that quickly. Honestly, I thought that the focus on inflation was much higher, at least for longer. But in fact, I think that the big story is not interest rates higher for longer; it's really inflation higher for longer is the real risk here. So let's go to the next chart. And by the way, that's at the core of our views in a lot of things. And one chart that I was going back and kind of reordering our macro presentations. I'm going through all these charts that we had, and this chart still is in my mind. It basically looks at the rising cost of debt. So the impact of interest rates higher. Being higher is that the cost to service the debt is higher. So therefore, we're 3%, basically 3 percentage points of GDP just to pay down the debt. Think about that. And at the same time, the red line is showing how much the government is actually, or I should say, the Fed is really owns still owns of U.S. Treasuries, and as the market as the government floods the market with Treasuries. And the Fed is actually doing QT. What we're seeing is that the ownership of the Fed on Treasuries has actually been declining. So this is completely unsustainable because we know that if the white line keeps going up, then the red line needs to go up because somebody has to be responsible for this. And so, ultimately, that's the whole reason why we believe that hard assets are likely to do very well. It's because the Fed is likely to be responsible for the white line in this chart, and the cost of the debt is going to have to be suppressed at some point. When the cost of debt has to be suppressed with inflationary forces embedded in the economy, that is a very explosive combination for hard assets. And so this is why I love talking about that. But let's go to the next chart. All right. So growth versus equal weighted S&P, very interesting chart, just a double top because I do believe in this rotation thesis. We just had a call with a client of ours, and we've been very vocal about this rotation idea. And I do think that money has to come out of somewhere in order to come into somewhere else. And I think technology has to be serving the resource space at some point here in terms of the capital flowing into commodity businesses. And so, I pay attention to things that are very overvalued too. And that's one of them, growth stocks. And guess what's the biggest part of growth stocks? Technology and consumer discretionary. Those are the real, problem child in the S&P 500 today, or in the U.S. equity markets in terms of valuation and declining growth and so forth. And so that to us is where the risk it really is posed in the economy. Let's go to the next chart. And so you got insiders selling their stocks in the technology space. I guess Peter Thiel was one of them, and you had Jeff Bezos being another one, and Mark Zuckerberg being another one. So the list of folks doing those types of making those types of decisions is certainly not short, and you should be aware of that. And then if I would point out to one of them that is, I might view, one of the smartest investors out there is Peter Thiel. If the guy is making a move on reducing his exposure to technology, I think you should at least take note of that, because he's a really smart investor, and I pay attention to him very, very closely. Let's go to the next chart. Promise, I'm almost done. Here's an interesting chart about the S&P 500 relative to the CPI, basically real term S&P 500. And you can see this channel. Now, I would have probably done this chart a little bit different. I would probably do a channel. Although that's obvious because of the circles, I would probably design this a little bit different. But it's a great chart, and that's why I have it here. And you can see here that we're probably at this kind of upper side of that channel as well. By the way, if you look at earnings in real terms, it looks exactly the same way. Earnings have been up, and we're likely at the very kind of near a pivotal moment for earnings to start contracting as well. They have started contracting a lot of companies, and so the company or stock prices should follow as well. Let's go to the next chart. And my last point is an idea, that we've been thinking about a lot about. At least I've been thinking a lot about is, the Fed is turning dovish, clearly, and you can call it political, or Fed is forced to do it, and so forth. But they've turned dovish, and so this idea that we're going to see higher interest rates in the short term, and the short side of the market, of the treasury market, short duration treasuries is less likely. And the other side of it is that inflation is reaccelerating. So that increases the pressure on the 10-year yield to rise. So what is the idea that comes to my mind? It's in the next chart. It's the steepening of the yield curve. If you have a Fed that is not willing to go and chase inflation, and you have inflation reaccelerating, causing the forces of the long-term trend on treasuries to actually increase the long-term yields of those treasuries, on top of knowing that foreign central banks are not participating in this market as much as they used to in the past, and also knowing that the yield curve has been as inverted as has been in history, and the most inverted has been in history in terms of timing. I believe strongly that we're going to see a very strong steepening of the 2 versus 30s or the 2 versus 10s on the yield curve spread. And I think this is an interesting trade. And it may happen actually in other countries too, not just the US, but the US is the main one, and certainly looks very attractive. And I think that's kind of a recession play. If you look at other times in history when the yield curve is steepening after being deeply inverted, well, those are times you also need to be careful, because that's usually aligned with a recession. So